What's up, everyone? This is Tyler McBroom, and welcome to the Cash Flow and Grow Show, where we teach you the financial habits and routines and tax tips that you need to turbocharge and increase your cash flow. All right, we're back for another Q&A session today. We got some things around entities and some things around what to do before the end of the year, because we are right in the thick of tax planning season, which is the time of year where it's your last chance to do whatever you need to do to minimize your taxes. Because when it comes to the end of the year and the clock strikes midnight on December 31st and everyone wishes a happy new year and the ball drops in Times Square, then the clock runs out on what you can do to lower your taxes. So we want to make sure we're getting you as much information as possible before then. Of course, after the year, we'll be talking about tax season and looking at your numbers and making your business more profitable. But the Q&A today is tax related. So the first one is related to sports, and particularly gambling on sports. And so the question is, Tyler, can sports betting losses be used to get money back on your taxes? And the answer is, it depends. It kind of depends on how well you did on throughout the year on both winnings and losses. So unless you're a professional gambler, you can deduct gambling losses to the extent you have gambling winnings. So if in that's sports betting, that's going to the casino and putting it all on black on the roulette table, that's throwing the craps, whatever your fancy is on the gambling side of things. If you have winnings, you can, and then you also have losses, you can deduct the losses up to the amount of winnings you have. So let's say you gambled throughout the year and you won $5,000, but you total it up and it turns out you lost $8,000. Well, the maximum amount you can deduct as gambling losses is that $5,000 winnings amount. And then the other wrinkle to it is where gambling losses are reported on your personal tax return is on your Schedule A itemized deductions. And so even though you can deduct losses to the extent of gambling winnings, you will only benefit from it from a tax standpoint if you itemize your deductions already. And so what itemized deductions means is there's something called a standard deduction that everyone gets. We're almost at the end of 2024, so in 2025, it's going to be $15,000 per year if you file single. If you're married, it's $30,000 per year. And you don't itemize your deductions unless the total of all your itemized deductions exceeds that standard deduction amount. Now you can, but it'll just cost you more in taxes. And the exception to that is if you're married filing separate. So you're married, but you file two separate tax returns. If one of you itemizes, the other has to itemize, even if it is a negative tax effect. But for most people, it's single or married filing joint, or head of household, which is it's just a slightly different standard deduction amount. But let's use the married filing joint example. So at $30,000 of a standard deduction, what goes into your itemized deductions is medical expenses, it's mortgage interest paid, it's property taxes, it's state income taxes up to $10,000, state income taxes and property taxes combined up to $10,000, and it's charitable contributions primarily. Those are the main itemized deductions expenses. And with medical expenses, it's subject to an adjusted gross income limitation. So in most cases, you don't even see $1 of medical deduction. We'll go into HSA and the benefits of that on a separate topic. But for itemized deductions, pretty much what goes towards it is your mortgage interest, your state and property taxes, and charitable contribution deductions. So if the total of those three, if you're married, is not above $30,000 or not above $15,000 if you're single, then you just take the standard deduction anyways, which means you would not get a dime of deduction on your gambling losses, even if you had $100,000 of gambling winnings in this case. So you got things to consider is you can deduct gambling losses to the extent you have gambling winnings, and you only get to deduct those if you already itemize your deductions anyways. So just keep that in mind when you're going to run that parlay on Sunday. All right. Next question is, First year in business as a single member LLC, taxes as a disregarded entity. Any tips? Well, the first tip I would say is really look long and hard on whether it makes sense to elect to be taxed as an S corporation. So if you're a single member LLC filing as a disregarded entity, for tax purposes, that's the same thing as if you're filing as a 1099 sole proprietorship. And what that means is your earnings up to almost $170,000 in 2024 are subject to what's called self-employment tax on top of income tax. And what self-employment tax is it's your portion of Social Security and Medicare as a self-employed individual. So how it works as a W-2, if you're an employee working for another company, if you look at your paycheck, the pay stub, that the amount you take home is not the total paycheck that you get, right? If you look at the detail, you have an amount taken out for income taxes. You have an amount taken out for Social Security taxes, Medicare taxes, and usually some local and unemployment taxes. Well, the Social Security Medicare portion added up total up to about 7.5% of your paycheck. And then your employer would match that and send 15% in to the IRS in the form of what's called payroll taxes. Well, when you go off on your own and start a new business, there's no one to withhold that 7.5% from the money you're collecting from your customers. There's also no one to match that 7.5% for you. But you might be surprised, the IRS still wants their 15%. So that means you're left holding the bag for that full 15% on the net income of your business from the very first dollar until you hit about $170,000 in profit in the year. And while that means that's great because you're earning Social Security credits and Medicare credits, who knows if those are even going to be around, in future years. But the way that Social Security works is you break even on Social Security, the taxes you pay, at a wage of about $50,000 a year. Beyond that, only about 5 to 10% of the taxes you pay go into your actual account. The rest go into the general fund and kind of get dispersed among other earners and Washington, right? And so what you can do as a single member LLC is elect to be taxed as an S corporation. The income tax stays exactly the same, but S corporation profits are not subject to self-employment tax. So instead, what you do is you pay yourself a reasonable salary for the work you're doing in the business, and then the rest you take out as a profit distribution. So you, instead of paying the 15% on the full amount, you only pay the 15% on the amount you pay as a W-2. So if you're earning, let's say, $100,000 in the business, which if you are in your first year, that's great. Then you might pay yourself a wage of $40,000. Now you got to figure out and check with your own accountant to figure out what a proper wage is for you. But in this case, if you pay yourself a $40,000 wage, you pay 15% on 40, aka $6,000, instead of 15% on 100, aka $15,000. So you save $9,000 by doing that in that exact scenario. And so usually the break even on when it makes sense to make that election to be taxed as an S corporation is around net income of about $60,000. And that's when the kind of the extra costs of the payroll you got to run for yourself and the extra tax return that you got to pay an accountant to file break even with the self-employment tax savings. So from there, anything above that, it's all gravy in terms of savings above that. Now, if you're already a single member LLC and you are at that threshold where you're at $60,000 or more of profit this year, there's some forms you can file as long as you meet certain criteria where you can make what's called a retroactive sub-S election and go. If this is your first year with the LLC, then you could go back to the very first date the LLC was operational and be taxed as an S corporation for the entire year and save that 15%. So that's the number one thing I would consider as a first year disregarded entity. The other thing would be something that's true for all first year businesses and frankly 5 and 10 and 15 year businesses that still haven't gotten this together. And that is get a separate business bank account, get a set of books. QuickBooks is super easy to set up. link your bank accounts on there, and start keeping your books up to date on a regular basis, keeping accurate records. Because number one, it's going to help you make better decisions for your business. And number two, when you think about income tax plus, in your case, self-employment tax, you might be in a situation where 40 cents of every dollar you miss as a deduction you're gonna be paying extra in taxes. So if you don't keep good records in your first year and you miss out on $10,000 of expenses, that could be a $3,000 to $5,000 extra tax bill at the end of the year. So that makes doing your books a little more sexy when you could maybe save $3,000 to $5,000 or more per year by doing that. All right, kind of another entity question. I opened my entity this year, but I didn't really start my business. I've got no activity. Do I still need to file a tax return? And this is a short question, but the answer is yes, you do. Even if it's a zero activity business, you still have to file a tax return if you formed, say, an S corporation. If it's a single member LLC, then you might have, depending on your state, some states don't require you to file the single member LLC return. Others do, so just check with your local state to see if it's a disregarded entity. You may have to still fill a form out. If it's an S corporation or a partnership, you absolutely still have to complete a tax return, or you could face penalties of a couple $100 per month per owner for every month that you're late, up to 6 months. So make sure you get that filed, even if it's a zero return, because that can get really expensive very fast, especially if you have multiple owners. What are some simple end-of-year strategies to reduce your taxes? Well, first off, make sure to schedule a tax planning meeting with your accountant. One of the biggest benefits of being a business owner is that you can actually do something about what you pay in taxes. And most business owners have no clue, or they don't make it a priority to actually meet with a tax advisor to give you strategies at the end of the year to reduce your taxes. So that's the first thing I would say, because then you know that you're getting custom advice directly applicable to your business and your personal life and situation. Next, a couple easy things you can do. Prepay any expenses that you've got coming up in the first couple months of next year, as long as you can afford the cash flow. If you've got expenses that are bills that come due, maybe it's a monthly cell phone bill, or the next car insurance payments coming up on January 20th, or your monthly office rent. But if you're going to have to pay those expenses anyways, if you cut that check or swipe that credit card before the end of the year, then you get the tax deduction now. Next is buy a new car or buy new equipment. If you've got equipment that you need to do, now I've talked about this before, only buy this stuff if you need it. Don't just go buying it just because you're going to get a tax deduction, because you're still spending more money than you're saving. But if you need it anyways, or if it's equipment that's going to help you scale your business better or faster, go buy that before the end of the year instead of waiting until early next year, and you can accelerate that deduction into 2024. At least if you're listening to this in 2024. Next would be, if you've got retirement accounts in place, max those out, or put as much as cash flow allows comfortably, or maybe squeeze a little bit extra comfortably, and do that before the end of the year, or be ready to do it before tax filing deadlines, depending on the type of retirement plan that you have. But you can max those out and get that deduction. You're paying yourself, which is great, and then that earns interest rather than paying the IRS. Next, hire your kids. If you've got kids, you can get them on the payroll, hire them. Now we're at the end of the year, so you won't really be able to pay them for the whole year, but you can maybe squeeze out a signing bonus for them to join your team and start doing actual work in the business. Now, if you do that, then they've got to be doing work that justifies the wage you're paying them. You want to actually give them W-2s, move the money into bank accounts in their names, and issue payroll tax reports and treat them as if they're normal employees. So make sure you do that. But that's a way to get a little extra cash to your kids, and then maybe they can buy their own holiday gifts. All right. So that's the kids. Next, if you own a home and you have an office outside the home, make sure you're taking advantage of the Augusta rule. So the Augusta rule is relatively little known IRS rule that says that you can rent your home if you own it up to 2 weeks a year, so 14 days, tax free. And so how you can do that with your business is you can once a month, or for a week at a time, or if you're throwing holiday parties, if you're using your home for business, whether that's a planning meeting or hosting clients for dinner or having a company party, you can rent your home out to your business and then cut a check and pay rent from your business to your personal bank account. That's deductible as rent expense to your business and becomes tax-free rental income to you. And then, of course, my favorite, go pay your accountant a whole bunch of money. It's tax deductible. They're your favorite advisor. The more you pay them, the more you get a tax deduction. So, hey, give your accountant a bunch of money. Now, I say that tongue in cheek, but any vendors that you've got that you're going to have to pay anyways, just like prepaying expenses, a lot of times you could go to them, and if you're going to stay with them and not move or change vendors, you could go and say, hey, if I prepay years of expenses in advance, can I get a discount? A lot of times they'll work with you, give you 10%, 15%. Even if it's 5%, that just you're getting the tax deduction accelerated a year further, and you also get a discount on the services you're paying. So that's those are a few options and things to consider right before the end of the year as far as simple ways to lower your taxes. So those are the questions we got for today. If you found value in this, go share it out, please. This is how we get the word out. I know that there's a lot of nuggets in here that a lot of business owners probably have no clue about and might be able to save them $1,000 or more dollars in your pocket or in their pocket. And if you bring them value by sharing this, then they're going to attach that value to you. So that's a nice thing to do. So go spread the cheer, and we'll talk to you soon. We'll see you next time.